Welcome everybody to this RankiaPro interview. Today we have the pleasure of speaking with William Higgons, president of Indépendance Asset Management and co-manager of its funds. Together we will be talking about quality value, the investment strategy the firm specializes in. William brings over 30 years of experience in investment in small and mid-cap companies. Since 1992, he has been at the helm of Indépendance Asset Management, and he manages as well the France Small Fund, one of the industry's longest-running and best-performing funds. So, good morning, William. How are you?
Good morning, Teresa. I'm very well.
Very nice to meet you. It is a pleasure to having you with us today. And now let's start this interview because there is a lot of interesting topics that we would like to talk about. So my first question is, what led you choose the quality value approach as the cornerstone of your investment process? And how does this strategy align with Indépendance mission and long-term vision?
Okay. I was very lucky when I started working because somebody told me that a company could not grow faster than return earning divided by net worth without increasing its leverage. So basically, from a mathematical point of view, you can't grow faster than return on equity, which means you better look rather closely at return on equity. So that is the quality approach. After that, I worked for two industrial companies, which were called Poulenc and Total, and I discovered that it was almost impossible to make a provision, even if you were working in the company and you had privileged information. So I do believe that if you can't make any predictions, but you can make predictions, but they will be wrong. It's better to buy companies which are rather cheap, because if they are cheap, you are not sure that they will have problems.
Okay, William, thank you so much. A little bit related to that, my next question is, what are the most significant challenges in implementing quality value strategies, and how do you and your team overcome these obstacles?
Okay, the problem with value investing is if you have some good performance, after a while, you believe that you are clever, and you don't really follow quality value any longer. You think that you can analyze company, and if you believe that they will grow fast, you buy them, even if they are expensive. So to remain quality value, you have to be sure, or you have to believe that it's not that you are clever, it's just that you buy cheap companies. So that is one of the first problems. The other risk, after a while, you will believe that if you have a good performance, that company in your portfolio are wonderful companies, and even when they become expensive, you keep them. So to be a value investor, you have to check every month, or let's say every month, that you are still a value investor.
Okay, that was very clear. Thank you, William. At this point, I would like to ask you if you could elaborate on the key criteria and metrics that you use to identify quality companies in your investment processes.
Okay, the main metric is return on equity. And if you think a little about it, you will find out that return on equity is much simpler than discounted cash flow and give the same results. After that, we use return on cash earnings. Cash earning is basically net income plus depreciation. We could use price earnings, But as price to cash earnings is not as used, it's better to look at that.
Okay, those were really useful insights. We have talked about the criteria used to identify quality companies, but how do you integrate ESG considerations into your investment selection and ongoing portfolio management?
Okay, we have always put emphasis on governance. When I started, I believed that if a company was very cheap and the manager was a crook, you could invest in it. After a while, I discovered that it was a mistake. It's you need to believe that managers are honest. If you believe they are not, you should not invest in the company. Environment is important because if you have a company which has a problem with environment, after a while they will have a problem with the government, with employees, or with people around the plant. So environment is important. Society is more difficult to use because if a company has no problem with the law, normally who are we to decide that what they do is bad for the society?
Thank you, William. And now that the ESG considerations are clear, let's discuss something a lot of investors would like to know. Which sectors or industries tend to offer the most compelling quality value opportunities, and why do you think this is the case?
Sometimes everybody wants to buy a sector, so we can't touch it. And sometimes the same sector, nobody wants to buy it, so we look at it. Normally, we are not able to buy any company in the pharmaceutical industry, but in any other sector, we can look at it. The technology sector normally is very expensive, so we don't invest in it. And in any case, we don't understand technology, so we can't. But basically, we can invest in any sector.
Okay, thank you, William. Now, my next question is related to your typical investment time horizon when adding a company to your portfolio. So, what is your time horizon and why?
Okay, normally when we invest in a company, we expect to keep the shares, let's say 4 years, but we can keep it very longer. If a company stays cheap and grows at a normal rate, we will keep it and expect the price earning one day to be normal. So we can keep a company for 15 years and it's not a problem. Sometimes we are lucky, the price goes up after some months and we sell it after some months. But on average, we keep shares something like 4 years.
I see. Now, we can all agree that in periods of high market valuation and widespread euphoria, managing the context can be a little bit challenging. So how do you stay true to your quality value approach while still finding attractive investment opportunities in these cases, in cases of high market valuation and widespread euphoria?
Okay, we know that we can't do any market timing, and everybody who does that normally loses some percentage of performance. So basically, we are fully invested, which means when the market is too expensive, we are fully invested, and the performance can be lousy, which was the case in 2018. We can't do much about it.
Okay, William. So now we are almost at the end of this interview, but we cannot say goodbye without asking you first, how has Indépendance Asset Management quality value approach has evolved during the years, and how are you preparing for the future market changes?
We keep our approach, even if the world economy change, which means today we have always, as always, a big discount to the market and a return on equity much higher than the market for every portfolio we manage. And we expect this strategy to work in the future.
Okay, thank you so much, William. Now, this is actually the end of this interview. From RankiaPro, we would like to thank you for finding the time to be with us because we know that you are very busy. So thank you very, very much.
Okay, thank you to have invited